Nilesh Shah joins us, represents Kotak AMC, needs no introduction, one of the finest voices in India in understanding macro, connecting our the dots here, and always, in a sense, he's been a guide for our viewers to do what to do and what not to do. You're starting early morning wearing a green shirt. ये green झंडी किसके लिए है?
No particular signal, Nikunj bhai. It's just what is available in the wardrobe. But maybe for long-term investors, it is still green signal.
But for medium-term and long-term investors, we can endlessly argue about markets are expensive. We can make a case that stock valuations are above that comfort zone. But when you have so much of liquidity, both local and global, then is it wise to come out of the market or book your profits or not stay invested? Because the force of liquidity can take this market higher and really higher before it peaks out.
Undoubtedly, Nikunj bhai, markets can remain irrational more than you can remain solvent. And it's not that Indian markets, bearing few certain categories, are looking at all-time high valuation or very, very expensive mode. Yes, one can say that Indian investor is like Indian cricket spectator. When Indian cricket team is winning all the matches in T20, we are expecting them to go and win the World Cup. Same way, Indian markets are also discounting all the positives and hoping that this trend will continue. Are we more optimistic about our markets? Answer is undoubtedly yes. But are we being irrational about our market, bearing few pockets? Answer is no.
How much of the strength in the market, which we think is local, which we think is flows, is purely global in nature? While we feel very happy about India, the bottom line here is that Nasdaq at an all-time high. S&P is doing very well. So the pillar on which equities are rallying is also global.
Undoubtedly, Nikunj bhai, it's a combination of local as well as global. Global investors have been behaving in an erratic manner. 1 month they are buyers, 2 months they are sellers. They are sellers in 1 month, buyers in 2 months. But they have been net additional purchases over last 2-3 years. And that's how they have contributed to our markets. Obviously, market is also expecting there will be no impact of geopolitical escalation on energy prices. Fed will cut rates. So to some extent, our markets are combining both local and global factors.
Nilesh, we understand that you were also part of the pre-budget meetings and consultations with the finance minister. Any color on what should we expect in terms of taxation, both for the capital markets and at an individual level? Because that's where all the hopes are.
So it was a one-way communication from our side, not two-way communication from their side. But we recommended finance minister that, you have done an excellent job. And we, the mutual fund industry, are the biggest beneficiary of the great work done by the Finmin. The vote on account laid the foundation for the rally in the market when people realized that budget could be pro-growth in terms of investment in infrastructure and yet fiscally prudent. With RBI's additional dividend of almost 1,23,000 crore over last year, the fiscal space has expanded. They can provide a budget which is vote on account, continued forward in terms of fiscal prudence as well as growth. One recommendation from mutual fund industry was that under the aegis of our regulator SEBI, we have done very good work on spreading financial awareness. And today we are seeing 4.5 crore investors securing their financial freedom through investment in mutual fund. But there is still a large portion who has not yet invested into financial instruments appropriately. In FY21 to 23, mutual funds got about 4 lakh crore flows. 9 lakh crore, double of that money went into currency notes, which are depreciating asset. So we requested finance minister to launched a copy of Jan Dhan scheme, which provided banking to every Indian, a similar Jan Nivesh Yojana, which can create a push and a pull both for the financial investment, let people secure their financial freedom through capital market.
Nilesh bhai, we had Rhythm Desai last week on the channel, and he said that if you look at Indian savers, less than 5% is in equities. A similar kind of a thought is echoed by you right now. A similar kind of a thought is echoed by all the other market veterans. So can I say that this entire domestic flow coming into Indian equities is a multi-year flow, and we are looking at numbers of at least 1,50,000 to 2.5 lakh, 2 lakh, 1 lakh, about 20,000 a month. That makes it about 2 lakh 20, 30 a year. That kind of a flow will continue for next 4-5 years.
Undoubtedly, Nikunj bhai. If you remember, when we had launched SIP Day, we talked about retail tsunami coming into the market. And those were khwahish, those were dreams. We hope that one day it will become true well before we retire. Today, it is glad to see that 4.5 crore Indians are securing their financial freedom through mutual fund investment. People who started early are today, enjoying the fruits. The returns on their portfolio are well beyond their expectations. Now, our focus is we have got the early start. Now we have to build the momentum. People lose money in Ponzi schemes. People lose money by investing in currency notes and cryptos and NFTs. People spend fortune in lottery. All these things does not create financial freedom for them. Many people depend upon their next generation and become a burden on them. I think it is important that we create financial security for every Indian through capital market participation, whereby they can generate real return. How can you make a country rich when 93% of savings of household went into either below inflation or inflation return products? Only 7% went into above inflation return products. We have to ensure that the 7% keeps on increasing so that Indians can become wealthy.
The other thing that the market, and I don't know, correct me over here if you if you observe the same, is the Telangana farm loan waivers. Given that the total budget deficit for Telangana last year stood at about 34,000 odd crore rupees. The budget deficit is currently at 2.4%. Just wanted to understand whether this is just a typical pre-election rhetoric, or is it some sign of a populist government and measures thereby in the times to come?
So as they say in India, whatever you say opposite is also true. On one side, we have seen states deteriorating on fiscal side, either because of, expenses running either through waivers or other ways, way ahead of revenue, and they have to resort to borrowing. On the other hand, there are states like Odisha, which are not there in the market to borrow because they are revenue surplus states. The royalty on the minerals and prudent management has ensured that Odisha becomes revenue surplus state. So we have both these spectrums, one where states need, kind of support from on the borrowing side to fund their expenditure. And on the other side, we have states like Odisha, where they are revenue surplus and they have not been accessing borrowing market for some time.
So let's not talk about specifics here. Last time when we spoke to you, you were of the view that one should look at FMCG or consumer staples, pharma selectively and IT specifically. That was a view which was, let's say, in and around the election outcome. Post that, has your view changed, given that there is policy continuity and there is more clarity as to where the government work will move in next 5 years?
So, Nikunj bhai, we still believe FMCG should outperform the market in the days to come. Election has resulted into money in pockets of consumers. The budget should boost rural and mass market product. There should be more money in the pockets of consumers through either increase in standard deduction limits as mentioned in newspaper today, or through some cut in taxes as expected. Overall, we believe with monsoon, budget, and election, there should be more money in the pockets of consumers, and FMCG should do well. Within FMCG sector, focus on companies which are innovative in terms of launching product, or they are able to cover new distribute, or they are able to cover more villages through expanded distribution channel. In terms of pharma, we still remain selective on a portfolio basis. We think there are medical shortages in US and there will be pressure on distribution companies to pay slightly higher prices and secure supply. US FDA action also probably will be driven by the fact that they are facing some medical shortages and they would like to restock the supply. Both these things will be positive for FMCG and pharma company. On IT, we want to wait and watch. Last time also I said we need to see if the appointment letters which they have issued is getting converted into real appointment in the office campus or not. As of today, it is still not visible. Valuations have factored in many uncertainty, but we need some catalyst from a growth point of view. Chemical sector is also poised like IT. We have to wait and watch because Chinese dumping still remains relentless. It does impact profitability and margin of Indian companies. They have large capacity which remains unutilized. At some point of time, Chinese dumping should come to an end. Indian companies also will become more cost competitive by improving processes or cutting expenditures. And over a period of time between IT and chemical, we will get good entry point. So both those sectors are right now under wait and watch.
So Nilesh bhai, final question. Let's talk about asset allocation for someone who has a short-term time horizon, which is 6 months to 1 year, 1 to 3 year, which is medium term, and 5 year plus. Which are the best asset classes to own? 1 year, 3 year, 5 year.
So up to 1 year, my recommendation will be to go towards arbitrage fund if you are high taxpayer, or go towards debt funds, money market funds, and short-term bond funds, where you could have limited benefit of drop in interest rates. Between 1 to 3 year, you can go towards longer duration bond funds. We believe over next 12 to 18 months, interest rates will come down globally as well as in India. And you will have benefit of coupon income as well as capital appreciation. Post-budget, one can also look at investment in precious metal. The only worry on precious metal is there is incidence of about 18% in India, including import duty and GST. If there is any reduction over there, there will be corresponding impact on rupee gold prices. But post-budget, if there is certainty on import duty to remain same, then one can look to invest in precious metal also. Beyond 3 years and more, I think one could remain invested in equities. A focus towards large and larger mid-cap at this point of time will be better from a risk-adjusted point of view. Only one note of caution: if you are investing in equity, do moderate your return expectation. Last 3 years has been exceptionally good. Probably over next 3 years, returns will moderate.
This killer caveat, Nilesh. But good to have you on the show as always. Thank you so much for taking the time out.
Thank you.
If you like this video, then like, share and subscribe to ET Now.